Hey guys, Infidel 1258 here. I want to do a video tonight, right before I fall asleep, in a series I'm going to start, and I'm going to call my closing remarks. I want to talk about silver, and I want to talk about U.S. debt crisis, and I want to talk about the recent interview between 60 Minutes and Jerome Powell, the U.S. Federal Reserve Chair. Nice, exciting conversation to help me fall into sleep. Okay, so silver is up and down, up and down, up and down. It's doing well in the mid $15 range, U.S. dollar range per troy ounce, but it could do so much better, and it will. And I'm really getting excited for silver because U.S. debt crisis is growing. It's really precarious, and the writing is so on the wall. Like, we look at the Federal Reserve, which is a private bank, coming forward to meet publicly with 60 Minutes to do an interview to kind of tell everyone that it's fine, that things are fine, don't worry, don't panic. Not only is Jerome Powell there, who's the sitting chair, the current chair of the Federal Reserve, but the two prior chairs were there, Yellen and Bernanke. What the heck is that about? The whole thing reeks of insecurity and conmanship. It's like a con game where they want to, convince everyone in the U.S. economy, whether it's corporate America or the little guy, that you can go ahead and keep investing in stocks. Things are going to be good. This is just a blip on the radar. We're not going into a bear market or a recession or a depression. It's going to be just, up, up, up from here. And it's a lie. And so I started looking into the data, and it's like, it's way worse than I thought. I mean, recently, I think it was this week, I saw an article posted online that talked about the automotive loans in America and how delinquencies in automotive loans are reaching all-time highs. And that was mentioned by 60 Minutes in the Jerome Powell interview. And Jerome Powell responded by saying, it's not a big deal because the number of auto loans being offered is higher. But that doesn't answer the question. That doesn't even begin to answer the question, because look, first of all, if you want to say that there are more delinquencies because there are more loans, okay, fine. That kind of makes sense, but it doesn't erase the problem. There still are 7 million delinquencies, which means 90 days or greater they haven't paid their auto loan. 7 million auto loans are delinquent in that way. And so that's a problem that the banks have to deal with. Whether it's justifiable or not, that's a major problem. And add to that the fact that Jerome Powell's answer didn't begin to respond to the issue, the underlying issue, which is this, that the auto loans growing in number is indicative of banks seeking to borrow money to riskier and riskier people, because these people that are going delinquent on these loans, they're not the creme de la creme of the credit world. They don't have 750, 800 credit score, whatever perfect is. I forget what perfect is, but they don't have perfect credit scores. These are the bottom of the barrel, and the bank is desperate to lend money so they can extract interest, and so they're reaching riskier and riskier. They're entering riskier and riskier loans because they have no one else to borrow to. And I've said it before on this channel. I'll get letters in the mail, as I'm sure you do, that say, "Come on over, Dwayne, get a new credit card." They won't even say Dwayne sometimes. It'll just say, "Dear sir or madam, do you want another credit card?" And that is indicative of what I consider predatory lending. Like, these companies are so desperate to loan more money because they want more interest, because they want to derivative up those loans into a product that they can sell as a derivative and make profit off of, that they are soliciting loans by carpet bombing neighborhoods. And so this is consumer debt. This is the crisis of consumer debt in America, but also in Canada. But then there's a crisis of corporate debt. And the data shows clearly that the corporate debt in America is higher than it's ever been. And worse than that, it's 3-to-1 debt to cash ratio. And so for every $3 of debt that corporate America has, they have $1 of cash available to pay down those debts. This is terrifying because the interest rates now are as low as they've ever been. Well, not exactly, but relatively as low as they've ever been. Average interest rates in America have been around 5.5%, and it's currently, I think, 2.5% or 2.75. And so these are low by historic standards. And 30 years ago, they were closer to 20%. So these are very low. And so if we even moved back to 5.5%, which would be historically average, corporate America would go bankrupt. And in that moment, default on their loans. And in that moment, the banks would fail because they would lose those loans. They would lose access to that would be a massive loss to them. But that's corporate America. What about the average American? Well, like I just laid out in the home loan or in the car loans, they are defaulting already. They are delinquent on those loans already. 7 million Americans is delinquent 90 days or greater on their car loans. This is the underlying problem is really the economy, and jobs are worse than people think, and inflation is worse than people think. And despite what the Federal Reserve wants to tell you, and despite what mainstream media wants to tell you, things aren't getting better, they're getting worse. And so, and I should add also that speculative loan numbers for average people, like this is like mortgage purchases for houses or land in America, the debt for an average person, not corporate America, is 8-to-1, which is itself an all-time high. And so on every metric that you look at, debt is at all-time highs. And then the U.S. Debt, $22 trillion now. It's like going up more than $1 trillion every year now. And this is with Trump and his alleged cuts and his attempts to try and trim the fat, as he seemed to suggest. And then you got student loan debt, which is crazy. America is absolutely tying the hands of the future to pay down the extravagancy and affluence of today. The wealth that we are enjoying today is going to be paid for by the future. And all of these loans will not be paid. They will be defaulted on if free market is allowed to reign, because banks will raise interests because they need to increase returns, and they should raise interest because allegedly the economy is doing great. Inflation is around 2%, which is not true, but that's what they say. Job numbers are great, which is not true, but that's what they say. And so they should raise interest rates because good economies deserve to you raise your interest rates when the economy is thriving. And so, but we saw in November and December of 2018 that when they tried that, the stock market crashed. The Dow Jones went down 19%. That's almost a bear market. It technically isn't a bear market, but it was almost a bear market. And it was the only reason it didn't go further in that moment was because Fed Powell was already kind of hinting he was going to ease up on the lowering of rates, of the increasing in rates, and because the plunge protection team, which is backed by the Federal Reserve itself, and I forget who else, but they come in and they buy up stocks and bonds when no one else is buying it. They're the buyer of last resort, and so things are far worse than they appear. And things are far worse than Chairman Powell will have you believe. Even the idea that a private bank, which is the Federal Reserve, is a private bank, it's owned by private banks, and that they would show up to a public interview to voice explanation and justification for their practices is indicative of how bad things have gotten, because it's really desperate times for them to try and convince you and me that things are going to be just fine. Think of it this way. If everything was really fine, would your pilot come out from the cockpit and talk to the people in the plane and say, "Don't worry, guys, everything's okay"? If everything's okay, what are you talking to me for? Go do your job. Everything's not okay. The stock markets are falling and we're collapsing, but we're stopped only short of plunge protection team involvement and Fed Reserve promises to no longer raise rates. They must raise rates, but they won't. The only healthy thing to do and the last opportunity for America to save the dollar would be if they raised rates. That would actually be terrible, but the best thing. Terrible because it would cause a significant recession, maybe even a depression, because absolutely there would be defaults, there would be job losses, the economy would have a real downturn if they raise rates to 5.5%, 6%. However, that's what they need to do if they're going to save the dollar. But they're not going to save the dollar. They don't want to save the dollar. They will print more through quantitative easing the next time the recession comes. And a recession will come. Recessions always come. Don't believe this hype about we can always be in a bull run. This is the longest bull cycle in American economic history, and it is not sustainable. What goes up comes down, and absolutely a recession is coming, and that is natural. So there are two choices before the American economy, before the Federal Reserve. Raise interest rates, allow the free market to settle, and it'll mean job losses, it'll mean economic contraction, it'll mean pain and suffering and poverty for a long time and for a lot of people. Or sacrifice the dollar by hyperinflating it through quantitative easing and a campaign of fractional reserve lending to just literally carpet bomb money into the streets of America and Canada, because we are that connected. It'll happen where America will just forgive debt, or maybe they'll forgive that student loan debt, or maybe they will give massive tax returns to every American citizen, which will be intended to incentivize their spending and hopefully prop up the economy. These are things that people talk about. Or maybe they'll lower interest rates into the negatives, which some countries do. This is the craziness that's coming, and it's going to mean the end of the US dollar as we know it. That doesn't mean the US dollar won't exist, but it'll be hyperinflated into worthlessness. And in that moment, you're going to see de-dollarization across the global economy away from the US dollar. It'll no longer be linked to oil. It'll no longer be linked to the global economy. And you're going to see a move from the background into the foreground by maybe China, or maybe the euro, or maybe SDRs. Something else, some other fiat will try to step into that circle, but US will fail. And that is going to mean horrendous depression, the likes of which I don't think anyone alive has seen. I think worse than the 30s, the 20s. So guys, that's my take on the US debt crisis today, the 60-minute interview with the Fed chair, and if it's not clear, the importance of all of that is this: buy silver, buy gold, because fiat does fail. It always has, it always will. And yet gold and silver have proven across thousands of years to hold value. And they will continue to do so. And so that's my 2 cents on it, guys. I hope you found this interesting. I'm going to put some sources in the video link below. Thank you so much for your time and attention. Have a great night, and God bless you.